The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
This is Denise Nostrom, CEO and founder of Diversified Financial Solutions. Now more than ever, investment advice is needed. Not just where best to invest your money, but why. Are you investing for your future retirement? Are you retired and looking to maximize your income? Are you maximizing your income and concerned with leaving money for your loved ones? Are you investing for your retirement at the same time saving for your children's education and at the same time saving to buy another home? Are the markets in line with your goals? Are your goals ever changing? Please contact me at 631-758-8691. That's 631-758-8691, or visit us at diversifiedfinancial.biz. For over 25 years, I have been helping individuals, families, and business owners navigate through all market conditions with only one goal in mind, my clients. Visit me at diversifiedfinancial.biz or call Denise Nostrom, founder of Diversified Financial Solutions, at 631-758-8691. That's 631-758-8691 for a conversation about my most important client, you. Hello, thank you for tuning in. You are listening to The Financial Chick Show, and I am The Financial Chick. My name is Denise Nostrom, the CEO and owner of Diversified Financial Solutions, a full-service independent financial planning firm located in Medford. I am here live every Friday from 5:30 p.m. to 6 p.m. on 103.9 LA News Radio. Your Financial Chick is here to help you make better financial decisions and choices to improve your life and reduce your anxiety and stress about money. If you have any questions on anything we discuss on the show, you can check out my website at financialchickshow.com. If you missed any shows, you could listen to them under the media tab on the website. We are also on Facebook at Diversified Financial Solutions, so like our page and get updates and see what's happening. So today, well, first, TGIF, and I think we all feel that way. For some reason, everybody I talk to, it's been a long week, and I'm just really happy that it's Friday and a long weekend to boot. But I'm honored to have a special guest on the air with me today. I met him several years ago. He is a chartered financial analyst and most recently obtained his Chartered Alternative Investment Analyst certification. He has been a contributor to CNBC since 1995, discussing global technology trends and companies. He was also co-anchor on Market Week with Maria Bartiromo for 2 years. He is also on the investment committee with Independent Solutions Wealth Management, and most recently, he's become a full-time professor at the Citadel. I would like to introduce to you my colleague and friend, Paul Meeks. Paul Meeks, you there?
I'm there.
All right. Glad you're there. How are you?
I'm awesome.
All right. So you're calling in from the state of?
Charleston, South Carolina.
All right. Fantastic. How's the weather doing down there?
It's raining now, but no surprise, this time of year it's awfully hot.
Okay. All right. So you're liking it. Yeah, it's not looking so good here either. And we're hoping that things change for the holiday weekend. We've been not having good holiday weekends lately. So with all of the things that you're doing, you're really slacking off, Paul. You know, you really better start getting moving and get more active and involved, right? I mean, come on. So congratulations. Well, congratulations on a couple of things. I think the most recent thing was the Certified Alternative Investment Analyst certification. So tell me a little bit about that.
So I've been a chartered financial analyst for decades, and that makes you a pseudo-expert in publicly traded securities. Mm-hmm. And the reason I picked up the Chartered Alternative Investment Analyst more recently is it's all about privately held securities, things like hedge funds, commodities, real estate, venture capital, private equity. I felt like I needed to know that.
All right. Awesome. So, yeah, and you're frequently on CNBC, well, for many, many years now.
Right.
And
good or bad?
It's good. It's good. I've caught you many times, but I didn't realize. I was looking through your bio, and I didn't realize you were on as a co-anchor with Maria Bartiromo.
Yeah, this was years ago, because in the late 90s, early 2000s, during the internet bubble that people may recall, I managed all the tech mutual funds for Merrill Lynch. And so she invited me to be a guest on her show because, of course, back then everybody wanted to talk tech 24/7.
Absolutely.
And then I actually became a co-anchor with her for a couple of years on a show she had on Friday nights called Market Week. Of course, several years ago, she went from CNBC to Fox. Yes.
I watch her in the morning. I like her a lot. She's a smart lady.
Yeah.
So, well, I'm so glad you're here with me today. I mean, I think it's super pertinent that you're here, especially since we just finished the first half of 2021. And so this is the perfect time to do a mid-year update. So I guess let's kind of reflect a little bit about what has happened year to date in the market.
Yeah. So if you take a look at the bellwether for U.S. stocks, the S&P 500, it's up 15% in the first half. And if you
pretty good numbers.
Take a look at U.S. stocks, going back to the 1920s when they started calculating the data, a solid average year for stocks over that time is 10%. So we've had a very good year in 6 months.
Absolutely.
And I actually am pretty bullish on the second half. I try to pick and choose between different sectors of the economy I favor more because right now we're all about reopening U.S. economy. And but if you take a look at the forecast for economic growth this year, U.S. GDP, it'll probably be 7 or 8%. And to put that in perspective, before COVID, our economy being big and mature and kind of going along more like a ocean liner than a speedboat, was growing at about 2% per annum. And we're going to have a 6, 7, perhaps even 8% growth this year with the reopening of the economy, and that will be the fastest growth in America since very early in Reagan's first term. So it's explosive.
Yeah.
And not just in the States. We're going to have great growth around the globe. And that's pretty bullish. Interest rates have been on the rise, but they're still historically low, so that propels asset prices. I don't like bonds because rates are still so low that historically they're not really appealing. But yeah, I think we're not going to necessarily turn over in the second half. I think we'll continue to grow. We'll be higher between June 30th and December 31st. I don't think we'll do another 15% in 6 months. It'll be more moderate. But yeah, I think we'll have a good, when we get to Christmas, probably a good 20% plus year this year.
Wow. It's pretty exciting. I know it is kind of interesting when you track the numbers, year to date. I always say to clients, I'm like, well, this is like a full year number, and even that's high.
Yeah.
And even the year over year numbers, those look amazingly crazy too. You're looking at 30s, 40s, 50% returns in some cases. And it's a little bit of an aberration because we were at such a low last year. But I guess it really, it does make sense. I mean, interest rates being low and everything, and people are looking for yield and growth. And I know I feel like I've been on a treadmill that hasn't stopped and has no off switch. It's just been go, go, go. So people are excited and people are doing a lot of things. So that's very, very, very positive. So we feel very happy about things, but then, we were talking a little bit this week, and we mentioned one ingredient that could possibly hinder the market, perhaps not this year, but maybe in 2022 or 2023, and that would be the big inflation. So what, you want to give some thoughts about that and how that kind of goes into the market and how that could affect things?
Yeah, so I think folks know that inflation, if you were to describe it in plain English, is if you had a basket of goods that you buy, products and services, it's going to be the price you pay year over year. And so obviously you don't want to pay increasing prices. So inflation over time runs about 2% per year. That's actually healthy. However, with the pent-up demand, to reopen COVID, all of a sudden everybody wants to go back to the theaters and the restaurants. And with the supply chain being clogged because it got screwed up during COVID, we have unleashed inflation, which ain't good.
Right.
Inflation in the month of April was 4%, and inflation in the month of May was 5%. Obviously, we're through June. We haven't seen the June print yet.
Right.
And so those are, pretty scary numbers relative to where we've been. And 2 months don't make a trend. But if it continues, I think we could have some trouble. We have to rethink things. So there's two schools of thought. The bulls, or the optimists, think that the only reason we have inflation is because of the COVID transition, right? Lack supply, heavy demand, reopening the economy. It's transitory. It'll be spiked for a while, and then it'll subside once the economy gets back to normal. That would be the optimist scenario.
Right.
The pessimist scenario, the bears, they say that inflation is back. It is long-term. It is structural. It's not transitory. And so that could be an issue because if you're as old as me, you remember inflation in the late 70s and 80s was super nasty.
Mm-hmm.
So I'm waiting for more data. 2 months don't make a trend. I want to see June, then July, then August, and September. But if it continues marching forward, I must admit I will get a little bit worried. I'm hoping that the bulls are right, but I'm prepared for the bear scenario too.
Gotcha. All right, so we're hitting the break already, but we'll talk a little bit about that more with inflation and maybe some ideas of how do we structure our portfolios, do things differently to preserve what we have, basically, and not get affected. So this is your financial chick, Denise Nostrom, the company's Diversified Financial Solutions. I help you look for financial solutions when you feel like there are none. So stick around after the break. We'll be here with Paul Meeks talking more about the markets. Welcome back. You are listening to the Financial Chick Show, and I am Denise Nostrom, and my company is Diversified Financial Solutions. You can reach me at 631-758-8691 or visit my website at financialchickshow.com. I am here to help you on your financial journey. Over the years, things change, and I am here to help you navigate all of those changes. So I am here today with my colleague and good friend, Paul Meeks, and we are talking a little bit about the economy and just some different things to help you to manage your portfolio and your finances in a successful manner. So, Paul, are you back? I'm channeling the broker-dealer, actually. Did you see what I just did there?
Yeah.
So basically, we were talking a little bit about inflation. And I guess, if it does become a trend, like you say, as opposed to just a fluke, just a 2-month situation, what should people do? Like, how do we combat our portfolios, or what are some things we can do to protect ourselves from inflation?
Yeah. So first on the asset class level, when I talk about asset classes, I'm talking about big categories like stocks, bonds, cash. Mm-hmm. You probably have to lean into stocks because, unfortunately, when inflation and interest rates, which come along with it, are rising, bond prices go the opposite direction. So you can actually have losses in bonds, even though bonds are typically the quote-unquote safe asset.
Right.
So if you lean into stocks, which I do, the world of companies is divided into 11 economic sectors, kind of divided by what they do for a living. And there are a couple of sectors that actually perform well in such an environment. You would think none would, but there are a couple that do.
Okay.
One are financials, because banks love when interest rates rise because they earn more on their loans. Mm-hmm. So some banks actually have done poorly for many, many years. They're now having their day in the sun. Also, commodities companies typically do well.
Okay.
Metals and mining. Another area that has done very well, and I expect to continue to do well, is energy, because folks may not realize, but the price of a barrel of oil was up almost 60% in the first half of 2021. And so folks like Chevron and Exxon, even though they may be polluters, do well in the environment. They love to have a higher price for a barrel of oil. And then I say, lastly, some industrial companies, those guys that are not on the East Coast or on the West Coast or in the Rust Belt.
Okay.
Places like Ohio and Indiana and Iowa, they do well. And so I kind of focus on those names because they benefit from a it's out of control. It's the hell that has basket for everybody. But right now, those are outperforming some of the other yesteryear favorites, which have been probably mostly tech companies, at least the last decade or so.
Right. Well, that's an interesting point. So you being really tech sector is your baby. That's what you do. Technology sector was super hot last year. And a lot of it was because of it was in its lane, but really the dynamics of the pandemic and the stay-at-home orders. I mean, it just all it really was very positive for the tech sector. So let me hear your thoughts about the technology sector going forward. I mean, can it continue to just keep raging as strong as it is now?
Yeah. So there is no doubt that the world was moving from analog to digital even before COVID, right? We are becoming more digitized, everything we did, whether it be school, play, work. However, that trend was put in hyperdrive during COVID for the obvious reason, particularly, work from home. So I am very solid with my tech fundamentals, right? I think they're going to become even more pervasive in our lives. I think you have to have those innovators in your portfolio. I don't think it's necessarily the FANG stocks, Facebook, Apple, Google, Amazon, the yesteryear favorites. I think you might have some new leadership within tech, but they will do well. But the only problem with tech in the near term is if interest rates rise, their valuations get beaten up more than other stocks. So love them long term. Right now, cautious.
Okay. So are you saying for people to kind of put their toe in the water or just kind of wait? Like, what would you say with regard to technology?
Yeah, so I'll give you a kind of a benchmark to think about. If you take a look at the S&P 500 stock index, about 40% of its weight is in tech or telecom or tech-ish like companies. So I think over time in your stock portfolio, you should have about 40% of it in tech. Right now, I think it's okay to dip your toe in the water, but I would have less than that. I'd be a little bit underweight the benchmark just because I want to see more with inflation and interest rates. Because unfortunately, regardless of tech fundamentals, they may be trumped by higher inflation and interest rates. So I would be there, sure, but maybe less than that 40% weight of your equity portfolio, which is probably what you should think about for the long term.
Right. That's what I've been doing with my clients. Especially some of the names. Like I said, literally the number's been 40, 50% year over year. So we're taking some, gain off the table and kind of securing it and then ready to go back in, if things kind of pull back a little bit, which certainly could happen at some point. Well, we know it's going to happen. We just don't know when it's going to happen, right?
Yeah, I think there's another key point is think of some tech companies such as Zoom, right? Zoom had only been public for a couple of quarters before COVID. And at that time, it had 10 million average active users. Then we have COVID and everybody jumps on Zoom.
Right.
And now they have 400 million. So they went from 10 to 400 million in a year and a half. And so, yes, their stock popped, but companies like that were really brought to the dance by COVID, once COVID's over and things moderate, what becomes of their fundamentals? What becomes of their valuation? So some of the companies that were purely creations of COVID, you got to think about, do I want to buy that stock here at that price? Because I don't know what's going to happen to them after COVID.
Right. Yeah, it's kind of scary to see, just even looking bigger, what's going to happen to the buildings that, with people working from home and not going back. There's a lot of unanswered questions, I think, in just so many sectors of how this thing's going to play out,
Oh, no doubt.
It's definitely interesting. So I guess one of the other things of how it's going to play out, I know a lot of my listeners are concerned, as well as my clients, of some of the policies that are being floated by the current administration, like the capital gains tax changes and possible changes with cost basis. What are your thoughts there?
Yeah, so I think that we will have changes, right? President Biden campaigned on those changes. I would say two things, however. First of all, since it's widely discussed, it's already reflected in the stock market, right? The stock market is an efficient mechanism, and once something is known, even though it's a scary known, it's buried in the stock price, done. So there's one thing. We've already talked about it. The next thing is, I think despite the fact that the Democrats have at least a slight majority in the Senate, they don't have enough that the Democrats are going to be able to push through an aggressive tax package. They'll get something, but they won't get what they're advertising.
Right.
And third, the legislature is so tied up right now with the infrastructure bill that even when we do have tax changes, of course, I think they're going to be lighter than you think. I think it's also going to be further off than you think because there's a lot of stuff on the plate to get through Congress before they even get to it.
Mm-hmm.
So I actually don't think, particularly with the midterm elections coming up in 2022, you may not actually see a tax bill until 2023. And again, I think it's going to be less scary than you're thinking.
Okay. That's a good thing. Well, it gives us time to plan. You know, it's all about planning, especially being a planner, to get people in the right place. Well, believe it or not, we're coming to the end of the show. It goes so fast, Paul. But I hope you have a wonderful 4th of July weekend. And thank you so much for all of the information you shared with my audience and me. I always appreciate you. And hopefully we can get you up to New York here real soon.
Yeah.
Maybe get you in the studio live.
And I'm a big fan of you and your show. I think it's real cool.
Thank you so much, Paul. I appreciate it. So tune in everyone next week, everybody. We're having another exciting guest that we're going to talk about cryptocurrency, a show all about cryptocurrency. I know you're all waiting and can't wait to hear. There's so many questions. So tune in next week. And I hope you all have a safe and enjoyable 4th of July. I'm hoping for some good weather. We're looking out there right now. Not so good, but hopefully that changes. So good weather for all of us to be able to be outside, to enjoy the barbecues, boating, or whatever you're going to do this weekend. So have fun. And thank you for tuning in today. And I'll see you next Friday.
Advisory services offered through Blackridge Asset Management, LLC, a registered investment advisor. Securities are offered through Peak Brokerage Services, LLC, member FINRA, SIPC. Blackridge Asset Management and Diversified Financial Solutions are separate and independent entities from Peak Brokerage Services.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.